I guess on technology and all, one of the questions all of our listeners and viewers would ask, is this a bubble? Do you get a sense of a bubble here, like 99?
Not like 99. Public market valuations nowhere near what they were in 2000. But what's going on in the private market for a particular category of tech-driven company is a bubble, and it's like a bubble such as we've never seen before.
Is this the silliness about unicorns that just popped up in the last month?
This is the silliness about unicorns. Let's take it apart. More than 100 private companies with valuations above $1 billion. The valuations based on future revenues higher than the best comparable public companies. Premium to the public market by institutional investors, hedge funds, mutual funds, sovereign wealth funds, buying without liquidity. They can't sell the stock. Buying with no governance rights if something goes wrong. Yeah. And is it a bubble? There's a signature to a bubble. When the price goes up, demand increases, doesn't go down. The demand curve is inverted. So 2013, 2014, around $3 billion of private placements for tech companies above $100 million. This last year, $13 billion.
3 to 13.
3 to 13.
I find this amazing. We took a look at Spotify last week.
But that's private.
Yeah, it's still private. And they brought in Goldman Sachs to advise them on an IPO, and Goldman Sachs says, wait a minute, we got something here. And then Goldman Sachs instead told them, hold off on the IPO, invested its own money, brought in from sovereign wealth fund money as well. And I think this is, I mean, is it fair to say that the tech market is no longer a public market?
Well, for the time being. Yeah. For the time being. Because, first of all, like every bubble, there's a plausible story here. Yeah. The way the technology, the IT of the Internet has evolved, the friction in generating a global service appears to have disappeared. So you do have your FAGA companies, Facebook, Amazon, Google, Apple. And you have the fear, FOMO, the other acronym, fear of missing out, on the next one. So there's a plausible story you can create in no time flat an amazing multi-billion-dollar global business. That's the plausible story. But there's a test. Sooner or later, these companies either go public or they get bought.
But critically,
and there's and sooner or later, valuation is going to get related to operating cash flow.
I agree with that. We're going to go down the income statement and find out if there's any substance there, and the answer is, for many of them, there isn't. There's always an exogenous shock, a catalyst that makes this rumble and fall apart. What would you guess that would be?
Usually, the simple message, just like there's a signature on the way up, and that's demand increasing as price goes up, on the way down, the signal is too much supply. Back in 2000, it was
rates go up. Is Janet Yellen the thing that makes us stumble?
That'll have some impact, but there's a lot of latency in the institutional investment business. The big guys, Fidelity, T. Rowe, the sovereign wealth funds in the Gulf, are assembling money to make these investments. They're not going to be able to take those apart overnight. So this is going to run for a while, but there will come a test. Most of these hopeful Darwinian monsters will fail.
And I mean that within a general sense, not specifically Janet Yellen.
Hopeful Darwinian monsters is a great phrase.
And there will be one or two of these. It may be Uber, it may be Airbnb, that 5-10 years from now we'll look around and say, gee, this really worked.
But that's precisely the difference. Uber has cash flow. Uber has, and I'm not saying I like it. Some of these dreams don't even have the cash flow.
But even the ones with cash flow, you got two kinds of disruptive web services. The ones that are virtual, like Google, delivered globally, no touch on the ground. The ones that are delivering a local physical service, transportation, housing, lodging, they run into the local ecosystems that evolved over generations, and it slows them down. So some of these growth projections are likely to be disappointed, and these are all living off the potential for global growth across every smartphone owner in the world.
Bill, I don't want to put words in your mouth, but it does sound like you're saying that when you're not public, when these companies don't go public, the market has a hard time working. They don't know enough information, and so they're not liquid, and so they can't look at valuations, and so this is based more on hope than valuation.
It's based on the fear of missing out.
Fear of missing out.
And when you have the market test, look,
that's a game theory of it.
For every IPO for one of these companies that has worked, there's been one where the market price is 30, 40, 50% below.
And it's not
what
the A round, but it's not the A round that's going to get burned. Your friend Mark Andreessen is going to be fine. It's the sovereign wealth funds coming in at the tail.
That's right. Look, there's always a pigeon in a bubble. There's always a pigeon in the bubble.
What does that mean?
It means the last guy in.
Okay.
Turns out to have been the greater fool.
Okay.
Yeah, we call that trades that the Red Sox make for middle relief. Bill Janeway, when you look at Broadcom, I mean, is there a game theory there where everybody's got to go because time's running out?
Look, Broadcom's a phenomenal business. They were one of, we had another one, level 1, that delivered broadband over copper wire. 20 years ago, that was an amazing dream. Yeah. That's what brought the Internet really to the homes of first America and then the world. And then they migrated, they made the evolution into wireless.
Okay.
Phenomenal achievement. But, as you say, the economics of the business, huge capital cost, even just to design the stuff is now all made in Taiwan.
Okay. All right, I got to cut you off because I can talk for too long about exactly that.